In today's video, I am going to be explaining the RRSP versus the TFSA and which one would be better for you to use. So we're gonna quickly go over the basics of each one, and I made 2 other videos on specifically an RRSP and a TFSA, so I'll put those in the description if you wanna watch them. But we're gonna be talking about the basics of how they work, where an RRSP might be better than a TFSA, and where a TFSA might be better than an RRSP. So with that, let's get right into the video. What's up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, which is an online life insurance platform here in Canada, but I will tell you a little bit more about that later on in this video. Let's start talking about RRSPs and TFSAs. So as Canadians, we have access to basically these 2 different accounts that you can put a number of different investments in. And that's actually something important to note, is a lot of people sometimes assume that these accounts are meant to just be like a savings account or a low yield mutual fund or bond account or something like that, when that's not the case. These are simply vehicles that you can use, and you can put a number of different investments into these vehicles. They're not tied to any interest account or any specific mutual fund or anything sold by a bank. You can have a number of different investments in them. So I mean, the possibilities are really endless. They're not tied to any specific investment. It's just a vehicle in which you can use, and then from that vehicle, there's special tax advantages, but the investments, there's a whole bunch of them that you can use and put in there. So you might have seen these 3 different accounts on maybe an investment statement, or you may have heard of them in the investment community, but we have our RRSP, we have our TFSA, and then we have this 3rd one, which is called non-registered. And you might have seen that before, non-registered. What does that mean? All non-registered means is that it's, well, not in any of these other 2 registered accounts. It's basically like that other bucket. It's like everything else. You have your RRSP, your TFSA, and then everything else just goes into this non-registered. And all non-registered is just meaning it's fully taxed. There's no special tax advantages, but it's basically just an account where you have investments. So I'll quickly go over the basics of an RRSP, but again, I made a full-length video on that if you want to watch that, and I'll put that right there. Here's how it works. When you contribute into your RRSP, whatever you contributed becomes tax deductible in that year. So hypothetically, if your income was $100,000 and you put $10,000 into your RRSP, that means that it would be reduced by $10,000 and your taxable income would be $90,000. And I made another video on taxation in Canada. So if you're a little bit uncomfortable with taxes, I'll put that video there and you can watch taxation in Canada and understand how that works. Within this registered account, any returns that accrue are all tax deferred, meaning that you pay 0 tax on all the returns. And this has a really big compounding effect because essentially you can grow your investments and the compounding effect year over year over year until your later years, maybe age 65 or age 70, is exponential because you're not having to pay any taxes in the current year, and you can reinvest that capital and reinvest that capital, and the compounding effect just grows. So it's a very powerful account to grow your investments over time. Combine that with the fact that you also get to deduct income in a given year, and then you get a big tax return. The RRSP is a really awesome account. However, this is how it works when you withdraw it. Whenever you withdraw money from your RRSP, that will become taxable in the current year. So again, same example, you made $100,000 and you decide to take $10,000 out of your RRSP. In that case, your taxable income will be $110,000, meaning you'll have to pay some extra taxes and you'll have a larger tax bill at the end of the year. Now, there are some special criteria around an RRSP, specifically how it converts at age 71. I'm not gonna get into it in this video because I did make that other video explaining it, and if you're interested, go watch that. But yeah, RRSP, great account. Now, a TFSA works a little bit differently. A TFSA doesn't give you any tax deduction when you put money into that account. So there's no tax deduction. You made $100,000, you put $10,000 into a TFSA, you're still gonna be taxed at $100,000. The difference is, however, any returns that accrue within this special account are all tax-free, and this is the biggest difference. When you withdraw it, it's also tax-free. So it's not tax deductible when it goes into the account. However, it's not taxable when it comes out of the account, and that's the big difference. Now, again, there's some special criteria around a TFSA and all the contribution limits and how they work. Those are in the individual videos that I made full length on those specific 2 accounts. So go watch those if you're interested. That's just a brief overview of the 2 accounts. And like I mentioned, that 3rd account, which is non-registered, again, all that means is it's not in any of these other 2 accounts. It's fully taxable. There's no tax advantages. It's just a regular old investment account. Okay, I did mention at the beginning of this video, I would tell you about Affinity Life, and I do want to just quickly tell you guys about it. So Affinity Life is an online life insurance platform here in Canada. We started development on this in 2020, and we actually launched in 2022. So like I mentioned, I'm the founder and CEO, and I've poured my heart and soul into this project, and this is how it works. Essentially, I wanted to create a self-serve platform for consumers to be able to educate themselves on different products and instantly view quotes and find prices and find one that they agree with from a company in Canada, and then apply 100% online. So I wanted to try and digitize and revolutionize on this industry that hasn't really seen any growth in the last 100 years and make it fully digital. So you don't need a broker to come to your house and do the application. You don't need to have unnecessary meetings. You can do it all from the comfort of your own home on a smartphone or a computer. And it's not one of those things where you half fill out the application and then you have to have a phone call and fill out the other half and all that. No. It's all online. You can do it very quickly. It takes 20 minutes or less. You can find quotes instantly and apply 100% online for life insurance in Canada. So if that sounds interesting, I'll put the link in the description below. Okay, so now let's talk about RRSP versus TFSA. So now that you kind of understand the different accounts and how they work, let's talk about which one may be better for you. Now, in a perfect world, of course, you would contribute to both because they're both so special and they have so many tax advantages. And in a perfect world, you'd max both of them out and have a ton of investments in there. But we understand that sometimes our money is quite limited and we need to be very careful where we allocate it. So it depends on a number of different factors. It depends on your current earnings and your future earnings. It depends on your spending habits, and it depends on your savings goals. So if you're trying to save for something specific, that also will determine which account is best for you. Okay, so let's start with the RRSP, and I will tell you where it's good and where it's maybe not so good. So an RRSP works really good for those high income earners. And when I say high, I'm talking $50,000 or more in income. However, they expect to retire in a lower tax bracket because the benefit of this is that they get to use these tax deductions on their tax return and lower their taxes in that current year and save those taxes. And then in retirement, if they're quit their job and they're retired now and they're not receiving any other income, well, now that they can pull this out and they're in a lower income environment, so from that, they'll be able to pay less taxes when they withdraw those investments. Now, every year, if you do contribute to your RRSP, you will receive a large tax refund depending on how much you contribute. If you're working at a job, they're going to be doing what's called payroll deductions, meaning they're taking taxes right off your paycheck. The way that this works is they're simply making an estimation based upon how much you're making, and it's pretty accurate, more or less. So they're saying, we think that you're gonna make $100,000, so let's take taxes like you're gonna make $100,000. That's how payroll taxes work. However, at the end of the year, if you did contribute to RRSP, you've overpaid for taxes. And that's why we do our tax every year to say, okay, this is what you thought I would have to pay in taxes, but here's in reality what I do need to pay in taxes. And if you contribute to RRSP, well, that's gonna lower your taxable income, so you get a big tax return. I would say this, be very careful of where you put your tax return because you're gonna be receiving this large tax return, but you can't think of it like your money because eventually down the road, you're gonna have to pay those taxes again when you withdraw from the RRSP. So potentially either contribute it into your RRSP or potentially putting that money into the TFSA. That would be a really good way to do it. Taking your tax return, and you got a large tax return because you contributed to RRSP, and then putting that tax return into your TFSA, that could be a good choice. Another place where the RRSP wins over the TFSA is if you wanted to hold US stocks, US equities, US ETFs in a TFSA. Those are not tax-free. So the IRS, for some reason, doesn't recognize the TFSA as a tax-free registered account. So they say, no, we're gonna charge you withholding tax if you have any US equity stocks or ETFs in a TFSA. However, they do recognize the RRSP. So if you wanted to hold US stocks or US equities within a registered account, RRSP is the way to go. Now, two other ways where the RRSP would be beneficial for you is if, again, you're in that high income tax bracket, $50,000 or more, and you either wanted to save for a house or you wanted to save for some type of learning, maybe university or some other accredited program. Well, in that case, there's two different programs that you can do through the RRSP. One is called the Home Buyers Plan, and the other one is called the Lifelong Learning Plan. Basically, this is what it is. You can borrow up to a certain amount out of your RRSP for either buying your first home or going to university or another accredited place. And that's all tax-free. You can borrow it tax-free, and you do need to pay it back within a certain certain amount of time period, but you can then contribute to your RRSP for, let's say, a house, and eventually take that money out, buy the house, and pay it back over a certain amount of years. Again, I won't go into the details of that, but it is in the full-length RRSP video. One more thing to note about that, if you are interested in either of those two programs, you can actually use a spousal RRSP to double down on those programs. So it's 2022 right now. Here's an example. The home buyer's plan has a limit of $35,000 for your down payment. Let's say that, well, I mean, house prices right now are skyrocketing. Let's say you needed more for that. You could actually contribute to a spousal RRSP, double down on that, and borrow $70,000. $35,000 from yours, $35,000 from the spouse. I'm not gonna get into the specifics of that because, again, I made another video and I'll put it right there, spousal RRSP, if you're interested in that. Okay, let's talk about where a TFSA is really good and who that might be beneficial for. So if you're an income earner under $50,000, a TFSA is a much better account for you because the tax deductions that you're gonna receive from the RRSP are just not as beneficial because your taxes are just lower in that tax bracket. And again, if you're uncomfortable with taxes, I did make that tax video and you can go watch it. But if you're under $50,000 of income and you obviously can't contribute to both accounts, a TFSA would be a really good place to invest. The nice thing about a TFSA is that the contribution limit is the same regardless of income. An RRSP, the contribution limit is based upon your income, where a TFSA, it's the same for everyone. So if you're only making $10,000 or $15,000, it doesn't matter. You get the same limit as someone that's making $50,000 or $100,000 or $250,000. The limit is the same. Now with a TFSA, there's no restrictions on accessing your money. With an RRSP, it's quite locked in more or less because if you withdraw it, you're gonna pay taxes on that and you're also going to lose that contribution room. So you wanna be careful with that. With a TFSA, however, you're not gonna lose any of your room and you're not gonna pay any taxes on it. So the access to it is way better, but now that could be good or it could also be bad. And that's where talking about your spending habits and talking about what your plans are is really important, because if you're the type of person that when you see money in an account, you want to take it out and spend it, maybe an RRSP would be better just because you know it's more locked away and it's harder to access. Another benefit about the TFSA is that there's no timeline attached to it. An RRSP needs to convert into something at age 71, and then there's minimum withdrawals that need to be taken from it. With a TFSA, it's completely flexible. You can take it all out. You can leave nothing in there. You can leave everything in there. You can do that at age 50, at age 70, at age 100. It doesn't matter. There's no restrictions and there's no mandated withdrawals on a TFSA. So there's a little bit more flexibility in that regard. So I would say if you're trying to save for a house and you're under that $50,000 of income, I would say that a TFSA is probably a better account than an RRSP. Even though you do have that home buyer's plan within the RRSP, it's just not as beneficial, in my opinion, to get those tax deductions under $50,000 of income, just because they're not as beneficial. You're not going to save as much tax. Your marginal tax rate's going to be lower. I think that's really everything that I can say about an RRSP and a TFSA. If you guys have any questions, please feel free to drop them in the comments below. And if you guys enjoyed this video, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.